Good evening, guys. Thanks for joining us today. Today, we are joined by Leo Marte and excited for him to share a bit about his perspective. He's got a wealth of knowledge in the financial space. He's definitely an expert there. And so, as we talk about investments and where to place money, kind of a go-to guy. So excited to have you on the show, Leo.
Thanks, Liam, for having me on the show. I appreciate the opportunity to talk to the audience and have a great conversation about money tonight.
Yeah, excellent. As we get started, do you mind introducing yourself to the audience?
Absolutely. So as Liam mentioned, my name is Leo Marte. I'm a certified financial planner. I've been in the financial services industry for a little over 13 years. And I manage my own investment firm called Abundant Advisors. I primarily focus on helping Christians who have achieved a certain level of wealth or earnings, manage their money wisely. I do also have a strong emphasis on generational wealth, which is a big passion of mine, and it's something that I work on regularly with my clients. Other than that, I live in North Carolina after having spent most of my life in New York and Pennsylvania. Live here with my beautiful wife, 2 kids, and one on the way. So we'll soon be a family of 5, which is awesome. We're very excited about that.
You got your hands full and you're definitely busy.
Absolutely.
That's awesome. How did you get into financial planning? Is that what you studied in school? Is that where you knew you wanted to go? Or, how did you end up there?
My journey into financial planning is kind of full of detours and interesting turns. I actually went to school for computer science. So when I graduated college, I came into the professional world wanting to be a software developer and work my way up into software architecture and sort of high level technology type work. And as I got my first job out of school at a little known company, Vanguard, which is as of course I'd say it in jest, this huge, investment management firm. I learned that I had a passion for investing and I had a passion for money and understanding how capital is invested for growth and to fulfill people's goals. And retirement was the initial focus of my journey because I was a developer in a part of the business that had to do with pension administration. So I got to know intimately well how pension plans work. Then I moved to the 401k side of the business. And through a series of job moves throughout my career where I transitioned from being an IT guy to, doing project management, eventually business strategy, and ultimately a people leader with client relationships, I learned a lot about myself. And I realized at every turn that the closer I got to the money and the goals and the client, the happier I was in my job. And that's what kind of led me into financial planning, financial advice. And that's the space that I live in today.
It's almost like computer science is less of a people-person relationship business, right? Very much a hard-coded, no pun intended, right? Like type of environment. So big shift for you.
Believe it or not, though, even though I spent most of my time talking to clients, I do a lot of video, a lot of work on the online in terms of education. I'm actually an introvert. And one of the things that attracted me from computer science was the fact that I could spend vast amounts of time solving problems and sort of working with my brain to fix something. And it didn't require me to be talking, all day. But what I realized was that, what got me excited about advice was not that I was, going to be in this introvert little space, is that I was talking about something that was interesting and exciting to me. And that actually gave me energy and excitement to go chase that. So yeah, but computer science teaches you a lot of really great problem solving skills, analytical skills that are super valuable in my work as an advisor today. So I by no means I'd say that I left my roots in computer science yet.
So as you started to earn more, obviously you're in a financial institution that deals with investments, and you had discretionary income, you had extra profitability. How are you looking at kind of investing your money early on?
I think that the easiest way that most people start investing is, of course, their 401k. And the 401k is an easy vehicle for you to do so because most employers have a match, which kind of gave you 100% return on whatever money you put in up to that match. And then you have these very nice tax sheltered envelope where you can just stuff money and money grows without current taxation. Because as you know, as you make more money in annual income, your tax situation gets more complex. The government is asking for their piece of the pie. And the more that you can put in tax sheltered investments, the better you're going to be over the long term so that your investments can grow without paying taxes every year. So that was the first place for me. I'm like, okay, this makes sense. I have a 401k. I can deduct it directly from my paycheck, put it away. Beyond that, I started working with a Roth IRA. At the time I was no longer eligible for a traditional, so I couldn't even go down the traditional IRA path because of income limitations. So I went with the Roth IRA because it looked like the next best place to go. And then my kids were born. So, I started working with 529 plans to make sure that we had money for college. So I would call that kind of the conventional, traditional investment space that is mutual funds, ETFs. And I think naturally, because of the way our financial system works, that is the first place that most people, not just me, but most people end up investing.
As you fast forward, obviously today you're working with high net worth people. I assume some of those are business owners. You worked with them in the past, right? Business owners don't necessarily have that same opportunity, right? Or entrepreneurs where they've got that 401k. So what advice or perspective would you share for, some of the listeners who might be, a solopreneur in your shoes today, right? Like, unless you go create your own 401k, which, you can do fairly easily when you've got just you, but if you've got a company, right? Like, what does that look like? And, is the thought process and recommendations the same, or does it take you in a different direction?
Well, I think that you have to sort of split the path between a solo entrepreneur and an entrepreneur with a team. So a solo entrepreneur, it's a very easy to open a retirement plan, and the limits of the amount of money that you can put in are significantly higher than a regular employee has, because you can contribute as both the employer and the employee. So you have both pockets of money and you can put money in both, and the total amount of money you put in is much higher than you would if you were just a corporate employee, W-2 employee. Now, if you have a team, your math is a little bit more complicated, because then you have to go into things like discrimination testing, top-heavy testing. You have to make sure that your high earners are not solely taking advantage of any retirement plan, and then your low earners are not, right? So the IRS rules have been created so that everybody can partake in the plan, but that also has a significant cost that is added to the business owner, right? You have to factor in the cost of managing the plan, the matches, and any contributions that you share from your profits with your employees. Regardless, though, of that cost, I think over the long term, it's healthy for the employee and it's healthy for the employer to have some sort of traditional retirement account available, both for themselves and for other people. Because what happens is, over time, as business owners, and I'm myself in that chair because I run my own firm, it is very easy for us to look at our business as our main source of wealth, or as our main store of wealth. But the truth is that you have no control over the valuation of your business and the longevity of that business. So the first thing I ask to a business owner who's solely concentrated into pouring capital into their business as their primary investment strategy is, hey, are you aware that there are other ways in which you can manage that risk, that concentration risk, by having a retirement plan, and start progressively taking some of the profits, not everything, but some of the profits, so that you can grow some security outside of your business. Because you and I know that when you look at the statistics, especially in the initial years, fail rate for businesses are pretty high. Economic cycles go up and down, which also put a business at risk. And it's helpful for people to understand that when you're putting all your eggs in one basket, it is as if I went out in the stock market and bought a single stock and put all of my money, all of my savings into a single stock. Granted, you know that stock, you manage that stock because it's your own business, but that's a very risky investment strategy. So I would say as the number one step, traditional investment strategy could help you manage some of the risk inherent in running your own business. That is not where you should end. There are other options and other things that you should do beyond that, but I think that's a good first step for people to take.
So as you're talking about concentration risk, right? More investment in a single vehicle. What's your guidance on what that, split should be, or the amount that you shouldn't exceed, in any one vehicle to kind of mitigate some of that concentration risk?
Well, it depends on, I would say depends on the individual and depends on the nature of the business that we're talking about, right? So if I have a client, for example, who is a corporate executive and their primary means of compensation is stock options or restricted stock that have a long vesting schedule, it's going to be really hard to avoid a pretty high concentration because they simply cannot do anything with that stock. They have to wait until certain rules and triggers are fulfilled in order for them to be able to sell. So concentration looks a little bit different, but once they can sell, we need to get pretty aggressive to make sure that all of their wealth is not trapped into that one company. On the other hand, you have a business owner. Well, business owners, for the majority of their life cycle for a small to medium-sized business, is going to be roughly 50% of your net worth, depending on the type of business that you're in. Once it starts exceeding 50% of your net worth, then I do start getting worried that if it's a large enough business, you need to have a pretty good exit strategy in order for your net worth to not evaporate if something were to happen tomorrow, right? Things like having a buy-sell agreement, having a good plan in place for successors so that you can step out of the business or even potentially consider a sale depending on your age and the stage in the business that you're in. Now, when we're talking about traditional investing, so stock market investing, I don't feel comfortable with more than 10% of my clients' portfolios being on individual securities. After 10%, the risk just starts really outweighing any benefit that you may get from growth. And I talk to people and they say, oh, I've been investing in Apple since like 1989 and, it's been phenomenal for me. It's like, well, yeah, great. But what happens in a year where Apple drops 20, 30% because the business cycle just so happened to catch it off guard? And that's the issue with concentration. It works until it doesn't. And sometimes it's really hard for investors to have high conviction to persuade them to diversify, but it's so useful, especially when the markets start having convulsions or high volatility.
So as you're working with some of these business owners and you talked about a large portion of their net worth tied up in the business, right? At what point do you try to give guidance in terms of pulling money out of the business, investing elsewhere, right? And what does that conversation look like? And what does that strategy look like?
The first goal that I want for any business owner is first to have a business that is cash flowing enough to pay for itself. And that includes the salaries, market rate salaries for all the employees. And after that, make sure that the owner is being paid a market rate for the job that they're doing in that business, right? Because sometimes we also try to suppress our own income in order to make it seem like the company's more profitable. But you really have to think about, if you had to replace yourself and you had to hire a CEO to run this business, how much would you have to pay them? And that is the amount of money that you should be paying yourself. When your business exceeds that threshold where you can pay your employees a fair rate, market rate, and you can pay yourself a fair market rate, then anything above that, you should start using some of those profits. And it really depends on what the type of business that you have and the goals that you have long-term for that business. But you should be coming up with a split to say, hey, some of this profit I'm going to take home and I'm just going to enjoy. And that could include giving, that could include vacations, that could include buying a toy. Some of that profit needs to go and be reinvested into the business. So your business can continue to grow, you can continue to hire if that's your aspiration, or buy new equipment, or stay on the front end of technology in your particular sector. And then the other piece of that, of those profits, you have to think about how are you investing in your team to incentivize long-term loyalty, right? So that is the part that, you would call traditionally profit sharing, but that's where you start incentivizing your key employees by sharing into the profits of the business to make sure that they're sticking with you long term and they have skin in the game. When part of their compensation is dependent on profitability, people behave differently. They start acting like owners, and eventually you may have opportunities to share in some of that equity as well.
What, in terms of investments, right, and where they would go, right? We talked a little bit about 401ks, right? Tax sheltered plans. Is that where you advise, some of these business owners to plan for the future, or would it be more, put it into the stock market or, something else? Like, what does that initial step look like for them?
So I would say yes. I'm intentionally answering your question with a non-binary answer. Yes. So the tax shelter accounts are all going to be in stock market-based investments. It's going to be index funds, mutual funds, stocks, bonds, the traditional asset classes. Beyond that, I think that business owners particularly need to start thinking about what their real estate exposure looks like. So, do you own your own home? Do you need to own the building in which your business operates? And that's a significant investment too, because, a small to medium-sized business, the property, in current market prices could be, anywhere from 500 to $1 million to $1.5 million or even more. If your business is bigger and it's a high, expensive area, that's going to be a big investment. And typically, as an owner develops a stable business, you want to own your location because that confers upon you some other, intangible and tangible benefits. So real estate is an obvious second. But then the third thing is, and this is where it kind of starts getting a little bit complex, and not everybody is ready or is not suitable for everyone. But entrepreneurs have a knack for investing in other businesses too, right? So especially when you belong to a community of other business owners and people who are in need of capital, entrepreneurs, successful ones, usually find themselves in positions to be funding other ventures. So many of them become angel investors, offering pre-seed funding to start new businesses. Some of them become real estate investors where they're actually buying rental units or multifamily type, real estate. Some of them end up just trusting a professional to go into a VC fund and then invest in, startups without having to have that direct knowledge. But that usually comes later on when there's a lot of capital at play. Usually in the beginning stages, it's traditional investments in real estate that lead the way because of their ease of access.
What do you tell a client who comes to you and says, "Hey, I want to be in crypto," or "Hey, I want to be in AMC," or "Hey, I want to be in GameStop," right? Like some of these things that are very prevalent in social media, big returns that are being seen, right? Like, where does that fit in the overall strategy?
Well, I would say if you're looking for, chasing returns, I'm probably the wrong advisor to work with. Before I even dive into trying to answer that question, I would say I would question the fit of the client to work with me because, our portfolios perform great, but we're not in the business of chasing performance because performance is largely outside of our control. The things that are within our control is, your cash flow, your debt management, all the elements of financial planning that we need to have taken care of for the long term, such as risk management, insurance, savings, college planning, all these things that are really important, way more important than, chasing AMC to the moon or whatever the expression is. Now, I would say there may be a place in somebody's portfolio if they do it in a very limited way to invest in individual securities. That's what I tell my clients. I say, hey, look, as long as you don't exceed 10%, and this is not a universal rule. It depends on the individual and their goals, of course, but 10% is just my upper limit. Like after 10%, I start getting uncomfortable when I have somebody having a position that's 15, 20% of their net worth. It's just too much. But I would say, understand the reasons why you want to invest in this. Understand that you could lose everything. This company could go bankrupt tomorrow and you can lose it all. And if you're willing to take that risk, then do it. But I'm not doing it for you. I'm not placing trades for AMC, every day. Now, when it comes to digital assets and crypto, that's a little bit of a different animal because it's a non-traditional asset class. There's not a ton of transparency in the space, and most people are attracted to it because of the novelty. So I don't manage crypto assets on behalf of my clients, and that's very intentional because there's also a lot of there's a lot of vague regulation around what is the safest way for us to serve individuals who want to invest in digital assets as advisors. So in the absence of a strong regulatory framework, my tendency is to kind of take a step back and make sure that we're not getting in too deep without clarity from the SEC and from FINRA and all these other regulatory bodies that we're accountable to. But when it comes to digital assets, the threshold should be a lot lower than 10%. It's probably like, hey, 1% is probably as much as I would put in, because as we have witnessed, particularly in 2022, in the middle of this market scramble, digital assets are collapsing. Like there are currencies, this supposed stable coins that are worth nothing. We have a lot of turmoil in this market, and people who didn't understand the risk that they were getting themselves into are getting pretty badly burned right now. So I would say proceed with caution. If you're going into any sort of esoteric investment strategy, don't believe the hype. Don't put any money on anything that you're not willing to lose, that doesn't have a track record, right, that you can assess. So that's my general guidance. But of course, that's different for everybody because of their own situations and risk tolerance.
What's the most exciting thing that you're investing in today or that you're working on?
Well, one of the things that I'm most excited about is starting to dabble in angel investing. So, being a business owner, I kind of like the operation of businesses, and I navigate in circles of people who are super creative, taking risks every day, pushing forward new ideas. And, I found ways to get involved in that space through my own personal network and through other sources that allow me to access, these types of opportunities. Now, this is, just to clarify, this is not an endorsement of angel investing. You should not go and search, angel investment opportunities after listening to this podcast. You should work with an advisor that knows what they're doing in order to do something like that. But as a business owner who's passionate about all their businesses getting off the ground and innovating in their own respective industries, I'm super fascinated about some of the companies that we're investing in with personal money, not company money. Just me as an individual and my wife, looking at really cool ideas. Some of them are moonshots that are really low probability but super high impact, and some of them are more traditional biotech, technology type startups that could really improve the quality of a lot of people's lives. So that's one of the most exciting things that I've been dabbling in lately.
So Leo, if the audience wants to be able to connect back with you, what's the best way for them to get in touch?
Well, the best way to learn more about my work is to go to abundantadvisors.com. That is the website for my firm, and we'll include the links in the episode description. In there, you'll find some of the articles that I've written in, related to personal finance. But most importantly, I also have an online course for people who are looking for a DIY tool, do-it-yourself financial planning, maybe not ready quite yet to engage with a financial advisor. And the options range from a free course to a paid masterclass that has a lot more depth and lots of templates and tools, and you kind of get to peek over my shoulder as I use some of the tools that I share with my own clients. And of course, there's the traditional wealth management side of my firm, for people who are really desiring to work with a professional that can help them, figure out their financial plan, look at the foundations of their life, build their long-term wealth journey, help their families have this vision of generational wealth. that's the kind of people that I'm most excited to work with. And as you look at my content, you'll see that I am very passionate also about working with people of faith. Not all my clients are Christians, but my business and a lot of the work that I do is in the faith space. So for people that are looking for somebody who shares their values, that's also another group of people that I feel most connected with and most identified with in this space.
Awesome. Appreciate you sharing your insights today and your guidance, Leo, and look forward to staying in touch.
Thanks, Liam.